Hello and welcome to Quant Street, a medium where we strive to evaluate and deliver the latest insights about the continuously evolving landscape of the economy and the macroeconomic fundamentals in play behind the scenes. So, to start with, let's go through some of the major developments in the month of June. Compared to the previous couple of months, which have been a major disaster from a health and economic standpoint. Let's start with some highlights. All three major US stock indices lost well over 5%, posting their worst one day percentage drop since March 16th, last Thursday, when the markets were sent in a free fall by the abrupt economic lockdowns put in place to contain the pandemic. The ISM manufacturing index was up by about 1.6%, and the non manufacturing index was up by 1.4% over the expectations. Nasdaq reached all-time highs, showing almost a V-shaped recovery in the markets, and S&P is on track to recover almost all its losses and go back to the same level as it was before the pandemic struck. CPI fell by 0.1%. The consumer sentiment increased from 75 to 78.9, and Fed Chair Powell spoke last week and he said that the Fed is going to support the economic recovery by supporting the current rates and keeping them at 0 to 0.25%. And so they are going to keep the rates steady through 2022. The Fed keeping the rates steady through 2022 could give investors the impression that the Fed may be more concerned about the pace of economic recovery than originally anticipated. And because of that, the market fell last week by almost 5% on a single day. Biggest loss since March 16th of this year. The economic data that also came along appeared to back up the Fed's gloomy predictions and jobless claims. The unemployment numbers are more than double their peak during the Great Recession in 2008. The claims are dauntingly high at 20.9 million. Let's delve deeper into the details and start with the Fed's policy announcements. The Fed had forecast that the US economy would shrink by 6.5% this year. The Fed expects the US economy will return to growth in 2021 with unemployment falling to 9.3% and GDP increasing to 5%, followed by a 3.5% growth in 2022. So looking at the forecast employed by Federal Reserve, it seems in terms of economic recovery, it's not going to be a kind of V-shaped recovery expected, and as we have witnessed in case of Nasdaq and Dow Jones, which essentially are not a measure of economic health, rather a measure of how the stockholders perceive the market to behave in the future. So a statement from Fed said that the ongoing health crisis will weigh heavily on economic activity, employment, and inflation in the near term and pose considerable risks to the economic outlook over the medium term, it said in a statement. The median projection of 6.5% slump in the real GDP this year, followed by a 5% growth in 2021 and a 3.5% growth in 2022, with an unemployment rate of 9.5% in the final 3 months of this year and a 6.5% next year and a 5.5% in 2022, is not going to return to the same levels as pre-pandemic, which was right about 3%. Further, the US Federal Reserve also signaled that it plans years of extraordinary support for an economy facing torturous slog back from the coronavirus pandemic, with the policymakers projecting the economy to shrink 6.5%. The fresh policymaker prediction starts to show just how long that might take, and the officials see the unemployment rate falling to 6.5%, still a full 2 percentage points above where it was at the end of last year, representing millions of lost years of work and wages. At this point, We are not even thinking about raising rates, said Powell. Analysis from Yardeni Research shows that the Federal Reserve announced QE or quantitative easing for an unlimited period as the financial markets crashed in March, and since then it has been flooding the market with lots of cash. And the Fed's balance sheet, as you can see in the chart, has risen by 2.5 trillion to a record of 7.1 trillion during June. Its holdings of treasury securities increased by 1.6 trillion over the same period to a record of 4.1 trillion dollars. Apart from this, a relatively new index of economic activity, the weekly economic index, which uses timely and relevant high frequency data, was also released by the Federal Reserve, as can be seen in this chart, which shows a sharp drop in economic activity and then there seems to be a rebound. Currently, this index is at minus 11 and seems to have bounced back from the lows of minus 12 most recently. Some more announcements from the government. The Treasury Secretary Mnuchin said in a briefing to the Congress that they definitely believed another round of federal coronavirus aid would be needed. He said, which include measures to create jobs. The Congress so far has passed three COVID bills totaling $3 trillion dollars in programs, including small business payroll loans, payments to individuals, and money to healthcare providers and Federal Reserve trade market backstops. Mnuchin said that I think we are going to seriously look at whether we want to do more direct money to stimulate the economy, but I think this is all going to be about getting people back to work. Moving on to the unemployment stats, as we said in the beginning, that the consumer sentiment was up. The job report that came out previous week was actually quite encouraging. April saw a net loss of 20.5 million jobs, and that was a very conservative figure. May saw a net gain of 2.5 million. It looks, as you can see in the graph, which shows all the employees, total non farm in terms of millions, that is just a switch from the very big plunge on the negative side of the graph to the small uptick in a step up means the gain is only about 10% of what was lost by these most conservative estimates. And actually, Bureau of Labor Statistics came out with an explanation about why jobs seem to have gained. And they told that there was a misclassification error. So a lot of people, about 5.4 million people, were included in the other reasons category. So the people who are not at work to the entire reference week for reasons related to coronavirus are misclassified as employed but not at work. The BLS analysis of the underlying data suggests that this group includes workers affected by pandemic response and who should have been classified as unemployed on temporary layoff basis, and the US Census Bureau are investigating why this misclassification error continues to occur and are making changes to the June collection. The workers who were recorded as unemployed but not at work for the entire surveyed reference week were classified as unemployed on temporary leave, and the overall unemployment rate would have been higher than reported by about 4.9 million workers who were not included in the other reasons category and should have been classified as unemployed on temporary layoff. And if these workers were instead considered unemployed on temporary layoff, the number of unemployed people in May would increase by 4.9 million from 20.5 million to 25.4 million. The resulting unemployment rate would be 16.1% and not the official estimate of 13%. Coming to inflation numbers that together with struggling labor market supports the Federal Reserve's commitment to maintain its very accommodative monetary policy stance for some time while nursing the economy back to health. The US Central Bank said that COVID 19 will weigh heavily on economic activity and employment and inflation in the near term. The Labor Department said its consumer price index dipped 2.1% last month after plunging about 8% in April, which was the largest decline since December 2008. That was during the Great Recession. Prices were held down by 2.5% drop in the cost of gasoline, which followed a 20.6% plunge in April. That offset 0.7% increase in cost of food last month, and food prices jumped 1.5% in April. An economist at JP Morgan said that the weakness in the economy should keep downward pressure on inflation over time, and we expect softness in the core measures to be reported for upcoming months. But we think that we probably have moved past the largest sequential monthly declines in inflation that came shortly after the virus spread. The BLS also reported seasonally adjusted CPI for all urban consumers, which fell by 0.1% in May. In summary, the US consumer prices fell for a third straight month in May, and underlying inflation was weak as demand for goods and services remained subdued amid a recession caused by the pandemic. So, from an inflation point of view, there seems to be some recovery relatively when compared with the month of April, or the CPI or Consumer Price Index seems to have marginally risen. The unemployment numbers can be debated, even if we go with the classification error accounted for, but compared to April, when there was a greater amount of unemployment, now it's increasing at a slower pace. But if we go by the official data, then it shows that the employment is coming back, though at a slower pace than what is needed for a V shaped recovery. On the manufacturing front, the nation's supply executives in the latest manufacturing ISM report on business said that the economic activity contracted in May and the overall economy returned to expansion after 1 month of contraction. The May PMI registered 43.1%, up 1.6 percentage points from April reading of 41.5%. This figure indicates expansion of the overall economy after April's contraction, which ended a period of 131 consecutive months of growth. The new orders index registered 31.8%, an increase of 4.7 percentage points from the April reading of 27.1%. And the production index registered 33.2%, up 5.7 percentage points compared to the April reading of 27.5%. Another major economic aspect is the energy prices. A series of localized COVID case spikes could have an effect on undermining people's confidence in traveling, restaurants, and entertainment. The coronavirus cases, which have been rising at a decent pace in some of the southern states, for example, North Carolina, Florida, Texas, and Arizona. On the other hand, the northeastern and the coastal states seem to have controlled the case spikes somewhat. And so the Brent crude futures fell $3.18 or 7.6% down to $38.5 per barrel, while the WTI crude was down at $3.26 or 8.2% to settle at $36.3 per barrel. So if the demand does not recover, US refiners and shippers will find themselves with further excess supply. US crude inventories rose unexpectedly by 5.7 million barrels last week to a record 538.1 million barrels. Some more news about the currency. The dollar, as we know, is on a silent slide mode as of now, and the dollar index that was trading at a 3 year high near 103 in mid March, and as the pandemic struck, it created a global scramble for dollars. The index has retreated around 5.9%. The dollar going down can be explained as a positive thing for the global economy, particularly since companies around the world drew down credit lines in an effort to hoard dollars, boosting funding costs. The Federal Reserve responded by expanding existing swap lines with major central banks and opening new swap lines with others, while taking additional steps to meet the dollar demand. And the Fed has kept on easing the policy on dollar, and dollar has dropped to a 3-month low against a basket of major currencies. So with that, we come to an end of this video where we looked at various economic variables and tried to assess the economy's direction in the coming days. Thank you so much for your time. And we'll have more such videos coming up where we recap the state of the economy on a regular basis. Please leave a like or a comment, or please subscribe for the algorithm, and if you consider our inputs valuable. All the references about the information provided in this video are shared in our blog, and you can find the link to the blog post in the description box below. Thanks again so much for tuning in, and we'll see you next time at Quant Street.